Thank you for coming to a very different kind of webinar from what we've organized in the past. We aren't going to have a presentation in today's conversation. I think it's just going to be a little bit more free flowing. And so I wanted to thank everyone for coming in. And we'll begin shortly. I think we're still seeing a couple of people join it. So maybe I will just give it 2, 3 more minutes before we start today's session. Thank you for your patience. All right, I think we've waited in, and I think this is stability in numbers. So let's get started on today's conversation. We wanted to spend some time. We wanted to spend some time decoding the RBI's monetary policy because we felt that June would be a fairly eventful policy given the kind of data that has led up to this. And I think if we do look at what the outcome of yesterday's meeting was, it's pretty clear that there were a lot of surprises, regardless of what end of the curve you were in terms of where your expectations were. So, firstly, let's look at what the RBI does. And once we have an understanding of how the RBI is structured, then I think we get a better sense of what drove them to make the decisions yesterday and how that can impact us as investors. So for start, no, there will be no slides today. It's just going to be a conversation. There's no presentation. It's different from what we've done before. We wanted to try this out. All right. Okay, so to start off with, like the RBI initially used to have a governor, and the governor was responsible for making all the decisions in terms of where monetary policy would move, right? So a lot hinged on the governor's dependent relationship with the government, and there were always question marks about how independent the central bank is. Now, in modern finance, we need an independent central bank because often the argument is that your political as well as your economic cycles happen at different times, and politics should not really influence what happens on the economic side, right? So to create a certain level of independence and to also ensure that what happened is that you're making economic decisions that are in line with what's the underlying reality of the country is, you ended up with this solution where you had a monetary policy committee. So the committee got to decide what happened, and it didn't rely on a single individual person, whether it was the governor or not. So let's try to understand what the structure of the monetary policy committee is. So you have 6 members in the MPC. You have 3 members who are RBI members. So that's the governor, the deputy governor, and one other elected representative. And then you have 3 external members that are appointed by the government. So this balance of internal and external members ensures that there is adequate representation across the board, and that you also have a diversity in terms of the opinions that are coming into the policy making framework. Now, while the committee was set up, I think in 2015, another big important shift that happened was that India did not have an inflation targeting mandate in the past. So it was only in 2016 that we introduced an inflation targeting mandate. And the basic thing in terms of what that does is it said that we wanted to focus on price stability as an economy, and as an institution, the RBI wanted to ensure that you're keeping inflation at a particular rate. Now, when you're looking at inflation as a number overall, what is a good level of inflation varies from economy to economy. So if you look at, say, the US economy, they've been fairly clear that a good level of inflation is 2%, right? Whereas their current inflation is closer to 4%. If we look at the Indian context, the MPC decided that 4% would have been a good inflation target. And there's obviously at no point are you going to be exactly at that number. So there's something known as a tolerance band. And for us, the tolerance band is plus or minus 2%, which essentially means that you could expect inflation to be anywhere between 2 to 6%, and that is considered normal. But the long term average really needs to move towards 4%. Now, this inflation target was set in 2016, and that was the decision for the next 10 years. So until 2026, there's going to be no revision to this. But in the first meeting that the new governor, that is Sanjay Malhotra, had, he did talk about looking at a more flexible target. Now, this is something that's under debate, whether you should have a number that you're working towards, or should it be a more contextual level, because this is going to constantly change, or is inflation something that even central banks can control? Because if you take the case of Japan, you've clearly had decades where the central bank has done easy monetary policy, reduced interest rates, gone into negative interest rate territory, all with the intent of fueling inflation, and that hasn't really moved the needle. But in the last few years, you've seen inflation move back, and that is not a result of monetary policy, right? So these are interesting debates to have. It's interesting food for thought. And but that also brings us to sort of understand where we are in today's context, right? So if we look at the inflation data that has come in through 2025 and 2024, we had an elevated level of inflation in 2024, primarily because food inflation was something that we were unable to really bring down. So a large part of what contributed to inflation in 2024 was food inflation, right? Then I think that stabilized because you had a good output season on the winter side. At the same time, you've also had a lot of interventions on the supply side that have been consistent from the government side. And today we are expecting an above normal monsoon. Reservoir levels are above average. So all the things that needed to be positive to control food inflation are actually moving in that direction. And that is reflecting in the data points that have come in. So if we look at the sort of inflation numbers that have come in this year, they're actually below 4%, especially if you look at February onwards, you're seeing these lower numbers. Now, if we are standing below 4%, the question is, okay, isn't it good to have price stability? Is inflation actually necessary, right? So with every economy, like we talked about that sweet spot, you do have a certain level of inflation which is necessary for growth, right? This means that you don't want too much inflation, meaning if your inflation is consistently above 6%, that's a little dangerous. And if your inflation goes below 2%, that's also dangerous. And we had a similar situation, I guess, in 2016, 17, 18, where you had inflation prints coming lower and lower, and your average was going closer to 4%, but that means the economy is really slowing down. So when we look at what the RBI projected, so if we look at, say, in the April meeting, they had said that inflation for the year would be close to 4%. And if we look at how that inflation projection has changed, in this June meeting, they've actually said that the inflation projection is going to come down to 3.7%. Right? And if we look at one of the surprises in this policy was that you have inflation coming in at 2.9% for the first quarter. So that's actually quite low. And then you see inflation picking up and it goes to 3.4, 3.9, and then 4.4% by the end of this financial year. Now, as you see, so this was one element that was there. But if we think about this particular policy and what came out of it, I think there were three big surprises. So the first is that you had a 50 bips or a 0.5% rate cut. And the RBI called this front loading, which essentially means that there was room to cut rates and they just decided to cut rates in advance instead of doing it policy by policy or meeting by meeting, right? And if we look at the quantum of rate cuts in total this particular cycle, starting February, the RBI has reduced your interest rates by 1%. So we've gone from, say, 6.5% on the repo to 5.5%. At the same time, the RBI also did something which was to change the stance. So they moved from an accommodative stance to a neutral stance. Now, when we look at the stance per se, it's something that gives us a signal as to what the RBI can or cannot do. And there are three broad stances that it can take. So you can have a neutral stance, which means you can maintain interest rates where they are, you can increase them, or you can decrease them. If you're in an accommodative stance, you can see that your interest rates can either stay where they are or they can go lower, which is where we were for a brief period of 2 months. In the April policy, the RBI moved from neutral to accommodative, and in the June policy, they flipped back from accommodative to neutral. So prior to that, so in your your post-COVID era, right before we had a couple of years where we didn't move interest rates at all, but the stance was withdrawal of accommodation. The idea was that you wanted to keep liquidity tight. And if we see where in the Indian economy was, say a year ago, we were in deficit liquidity, right? The basic idea being that you had a withdrawal of accommodation stance, so the RBI did not need to infuse liquidity into markets, and at the same time, because it was an election year, so capex from the government side wasn't really happening, and government spending was lower. You had this deceleration that happened in growth last year, right? But then post-election, you did see, like, with a 1 quarter delay, some capex occurring. At the same time, the RBI stepped in and they started doing liquidity operations. And then finally, I think you've also now in this year, they have intervened a lot to bring liquidity from the deficit state that it was in last year to a surplus of 6 lakh crores today. So if we look at the third big surprise that came in from this policy, it was along the liquidity side, because nobody was really expecting the RBI to cut the cash reserve ratio. Now, the cash reserve ratio, or the CRR, is something that banks are expected to maintain. You can think of it as idle money that's supposed to be as cash. So if a bank has 100 rupees on its balance sheet, 4 rupees previously needed to be in cash, and the remaining 96 could be used for the business purposes. So this 4 rupees has now been reduced to 3 rupees, and it's not with immediate effect. That's something that we have to note. It's something that will happen over a period of 4 fortnights, that is roughly 8 weeks from September to December, right? The idea is every 2 weeks, the cash reserve ratio will drop by 0.25%. So then you end up with a 1% difference from starting September and ending in December. The idea in having this is that essentially you can infuse liquidity into the system in a more gradual manner. And this explains the stance shift, right? Because the RBI has been fairly proactive in communicating and also signaling the kind of liquidity that will be available in the system on a durable basis, right? So if you do a rate cut today and you're already at liquidity surplus, you are sort of signaling that transmission for these rate cuts will be swift. At the same time, you're ensuring that it's not like a one-off event, because you're phasing that liquidity that comes into the market over the next few months and ensuring that almost till the end of the year, there is additional liquidity measures that are coming in. So if we look at other activities that the RBI has engaged in, you've also noticed that there have been a lot of open market operations in terms of buying bonds, which has been another way to infuse liquidity into the financial system. So these are all some of the measures that the RBI has taken over the last, say, 6 months or so in terms of getting liquidity back to surplus, right? So we're not at a neutral level. We were negative last year and more or less break even for a long period of time. And now we're in surplus liquidity. So when you're in surplus liquidity, it allows for faster interest rate transmission. And so what you will see is a few things. So your deposit rates, if you're a fixed income investor, the safer investments are going to react almost immediately to lower interest rates and you will move in that direction. If you're a borrower, I think there is a lot to benefit in this situation because your lending rates will also come down. And I think the segments that benefit the most, we can talk about this a little bit more in detail because I will leave some time for Q&A as well so that we can have a more productive and engaging conversation. But lenders stand to benefit when we're at lower interest rates, right? So then coming back to what we can expect from the RBI going forward, I think one statement that stood out yesterday was something that the governor said, where he said that the monetary policy is left with very little space to support growth going forward, right? And that's because they've already done a lot of the heavy lifting. So on one side, the government has changed tax slabs, has sort of done this entire rejig on the new regime as well as in terms of how to reduce an individual's tax liability. So that has been a boost in terms of boosting consumption. Now, the RBI has been pretty solid in terms of improving liquidity within the system. So they've done these preemptive rate cuts this time. So that's been a surprise for most of the market. And it also ensures that, if you do the rate cut in advance and the transmission occurs with a lag, then this occurs with a smaller lag than before because you're not waiting to cut and then transmit, right? So the signaling has been very positive. Did the market react to this very well? I think the bond market did not handle this news very well. So you saw a spike in your yields. If you're a long-term or a duration investor, then I think this is not really something to worry about. Usually when there is a big announcement, you will see an initial reaction, which is slightly volatile. It can be in either way. But once you give it some time for the dust to settle, then I think the direction also becomes much clearer, right? So from a macro perspective, there is nothing to worry about, primarily because we are in a fairly sweet spot, right? So we are in a spot where inflation projections are below the RBI's target. You're also in a space where growth is not being compromised. So we are not a slow economy. I think the growth projection that the RBI shared has not actually changed, right? Meaning between April and now they have maintained that the Indian economy will grow at 6.5%. And if you see that the nominal GDP growth numbers, which I think when we read headlines, we tend to sort of give too much weightage to what we read in the newspapers. But if you see that there's a dip in nominal GDP growth, I don't think that's anything which should be a cause for concern. The basic idea being that if inflation is going to be lower, nominal GDP growth is going to be lower, and we need to only focus on real GDP growth, which is net of inflation. So going forward, what is it that we can actually expect? So it's very clear that the risks that the RBI are seeing are not from the domestic economy. And they did share an interesting framework that they're playing around with in terms of how they view the Indian economy. And the governor referred to this as the 5 into 3 into 3 framework. So the three pillars of this framework are essentially balance sheets, stability, as well as investment opportunities, right? So if we look at the balance sheets, there are 5 different types of balance sheets that the RBI considers. So you have corporate balance sheets, you have bank balance sheets, you have government, you have households, and then you have the external sector. And if we think about how India is structured at this point, corporate balance sheets are pretty robust. So you've seen a lot of mergers and acquisitions, all of this occur because there is liquidity in corporate balance sheets. At the same time, banks have also done a full cleanup act, right? So we had this entire NPA issue. We had an entire cleanup that happened from, say, 2016, 17. You had public sector banks being recapitalized. And then you got very strict norms in terms of the IBC and NPA reporting. So this cleanup is still fresh, and this is what has strengthened bank balance sheets to allow banks and NBFCs to lend more. One thing which was concerning the RBI, say last year, and slowly that fear or that, so there have been a lot of proactive measures from the RBI side on household balance sheets, right? So there's been a lot of unsecured lending that has happened. And last year, there were many proactive interventions that the RBI did where they would step in and they would tell certain microfinance or NBFC institutions to pause lending or to come back on certain risk management things. So when we look at this, then you see that in this statement, there is a lot more clarity and a lot more positivity surrounding household balance sheets. And then, of course, you have the external sector. And if we look at, say, your current account, so your external sector is anything that's non-domestic, right? So if we look at how the current account deficit has moved, we're actually doing much better because we're able to trade more with other partners. We're coming out strong on a global front in many dimensions. Of course, I think global trade policy, there is a lot of volatility and uncertainty around that, and that is something that uh, needs to be watched. But as of now, I think given how negotiations have been going, at least for the next 1 month, we have some visibility that things are going well. So the second pillar, of course, is stability, and stability again comprises of three things. So you have price stability, you have political stability, and then you have financial stability. So if we think about price stability, that's basically a proxy for inflation, and I think we're doing very well on that front. So given that the RBI's target is 4%, we have been more or less at that level. Even when we've had a higher level of inflation at 6%, it hasn't really hampered spending or economic activity. On the lower side, when we had lower inflation a few years ago, that was something that caused a lot of concern, and you saw the economic activity decelerate, and they needed stimulus at that point. So I think lower inflation is a bigger problem for the RBI than slightly higher inflation. But at all levels, you need price stability, right? You cannot have a very wide range of inflation because that can also affect the way corporates or even governments make investment decisions. So I think that is clear. We've talked about bank balance sheets and the financial system. So I think there also we are fairly certain in terms of being financially stable. And when it comes to political stability, I think we are beyond the election year, right? So I think as of now, there is nothing that could really upset that apple cart. The only risks to stability come from outside. So if you have something that's come up, let's say you have something negative surprises in terms of, say, US India relationships or global relationships. We've inked out a deal with the UK, but let's say China and US negotiate a very favorable deal, then that may have some second order or third order impacts. And it's not just about China. I think there are enough competitive players in the world today for you to really not be able to anticipate where that instability could come from. The third thing, of course, is the investment opportunity. And I think here they had three pillars. So you have demography, and I think anyone who was listening to the India story in 2022 would be familiar with this, meaning we have the youngest working age population. We're not a population that's degrowing. So the kind of threat to economic growth that Japan and China are facing are not problems that India really has today, right? At the same time, if we look at digitization, which is the second pillar in terms of opportunities, I think we are ahead of the curve in terms of financial digital infrastructure. So right from your JAM Trinity, that is your Jandan, Aadhaar, and mobile, plus ensuring that people are adequately banked, and you have your UPI and your different interfaces through which you can digitally transact. I think we're definitely leading in terms of global economies. And lastly, we come to domestic demand, right? And this is the interesting part because even despite all of this global uncertainty, one thing which is clear is that domestic demand has been strong. And that is something that we can capitalize on. And that's where I think the India story also holds strong. So the reason we're looking at 6.5% growth is broadly because you're only dependent on domestic activity. There's a lot of global uncertainty as to what global demand would look like, and there are many drivers that are moving those things in different directions. So I've been talking for roughly, I think, 20 minutes now, and I do see one or two questions in the chat. So I'm happy to take these questions, but if anyone else has questions, please feel free to like type them in the chat box and we can discuss that. So before I go into Q&A, I just wanted to quickly give you an outlook in terms of where do you see different asset classes. So let's first look at or not just asset classes, but where can we focus our financial decision-making energies? So one is on the fixed income side. I think definitely you are going to see lower returns. So there is a need to lower expectations no matter what kind of investor you are. That has also been the theme of our outlook this month. The basic idea being that as interest rates come down, if you had taken a duration call earlier, then there is some scope for mark-to-market gains as transmission occurs. But if you're somebody who has not taken a duration call and you're looking at long-term debt today, then there are elevated risks. You need to be prepared for some level of volatility because the entry valuation matters a lot. The second thing, of course, is that if you're not, so you could, of course, avoid duration risk altogether because when you take duration risk, you can earn negative returns in fixed income. This is something a lot of investors don't understand, right? And then it takes a couple of years to recover from that. So you could lose time if you take a duration call at the wrong time in the interest rate cycle. I think as far as equities are concerned, we have cautioned a lot of investors that valuations have been stretched for a while, and you are moving into a slower economy. So a more bottom-up approach in investing is required. You can't expect last year's winners or past winners to really give you the kind of performance that they delivered before. So this context shift is something that requires calibration, that requires thought. It's not an easy environment to invest in. At the same time, if we look at real assets, whether you're looking at precious metals or any other kind of commodity, I think there is some space for this. But again, here, how you invest matters a lot because if you're in a low inflation cycle, then possibly commodities may not perform, or you'll have to look at individual dynamics before you get involved in that, right? So that's the overall asset outlook. As from a personal finance side, I think one important thing that you can look at is to restructure your loans. So when we saw the last rate cut cycle, one thing that we did for clients and investors was to sort of assess how whether refinancing their home loans made sense, how to deleverage their balance sheets so that they could invest in a better way. So I think this is a great time for you to go back and do that exercise with your financial planner or the investment professional that you're working with. All right. So with that, let me sort of start taking questions. So the first one is, can we still go lower on interest rates in the current financial year? Yes, I do think it's possible. Simply because of the nature of the stance, right? They didn't say they've gone from accommodation to withdrawal of accommodation. They've gone from accommodation to neutral. And neutral is this space where there's a lot more flexibility. So I think the basic idea of having the neutral stance is that, let's say you're impacted a lot more by global growth and the global environment slows down quite a bit, then you might need to stimulate the domestic economy and you might still have to cut interest rates. However, let's say that doesn't happen and inflation becomes a problem because global demand goes up and that's the issue. Then you don't want to be in a situation where you can't increase rates, right? And I think that when you're in the accommodative stance, you cannot, it's very clear that you can either maintain or cut interest rates. You cannot switch. So I think being in the neutral stance gives them a lot more flexibility to address both sides of the mandate. All right. Due to lower interest, people will be willing to take risk and may move money into equity. Equity may go to higher valuation. So I think this is a risk, right? That is why I said that investing in this environment isn't easy because you're seeing, so every time the dollar weakens, you're seeing monies from FIIs come into domestic markets. FII flows this year have actually been quite volatile. The exchange rate also has been quite volatile. And there is always this risk that if you completely sit out of markets, it may still go up. So the goal today is to not stop investing, but to stagger investing. I think if you take that approach, that you decide that you're not going to really put all your money in at once, but you are going to participate in a more gradual and continuous manner, then you're definitely going to come out on top. Because there isn't so much visibility also for you to be able to make these kind of decisions. Is it a good time to move from duration strategy to accrual strategy? How does duration strategy do when policy rates near bottom? So one important thing is like, yes, maybe we're close to the bottom in terms of rate cuts, or maybe we are at the bottom also. We don't know that today, but in hindsight, it will become clear. But the most important thing is just because the RBI cuts rate doesn't mean that the yield transmission has occurred, right? There is always a lag in terms of how transmission occurs. So if they announce a rate cut today, it takes time. And that's the main reason why they decided to do a 50 bips or a 0.5% rate cut yesterday rather than just 0.25 yesterday, then another 0.25 in August, because this lag can actually cost you time and you might lose 1 quarter of growth in that direction. So I feel that when you're looking at strategies, it's not the time to exit duration, but it is a question mark as to whether you should enter duration at this point. Um, so that comfort level to buy is not there, but it's definitely probably not a sell either, right? You do need to make that shift from duration to accrual. Accrual basically reduces the duration risk and it protects whatever you have. And when the interest rate cycle moves up, you don't really lose much in an accrual strategy. Whereas if you were in a duration strategy, you would lose money on the way up. So moving to the next question, from a domestic standpoint, which sectors are likely to benefit from the easing liquidity and lower interest rates? This is an interesting question, but I think uh, broadly, it's hard to tell because even if you look at the banking sector, on one side, if you have lower interest rates, it reduces the cost of borrowing, but it also compresses your net interest margins and excess liquidity. If you're not able to lend it, since the economy also is not growing, can be a drag on the balance sheet. So there's no clear-cut answer. You would have to actually do more of a sectoral analysis, and that's why I said this is the era where you need to look at bottom up investing, right? You can't, these top down calls don't work in this environment because top down, the logic is very, I mean, it's not very even in that sense. Will foreign investors sell the existing bonds that they hold? How is it good? I don't think so because, like, if we look at where the foreign flows have come in, it's predominantly been on the institutional side, and that has been because India got included in a few global bond indices. So when you're included in a global bond index, there is a mandatory weight that they have to maintain for each country. So it's unlikely that they will sell because there's a target weight that they need to maintain. Uh, and typically, I think when you look at bonds, you don't really look at them as like trading in like investments that you trade in and trade out of. I think what you see them as is more a hold to maturity kind of strategy. So I don't think there will be FII selling, like unless there is some big risk in terms of, let's say, suddenly you think that interest rates are going to spike up and it's like an unexpected move, then I think possibly that might trigger something. But that would mean, like, on a macro standpoint, many things have to go wrong before that happens. And given where we are in today's context, a lot of things are actually quite positive. So I don't see that happening. Interesting question. So I think one thing that stood out in the policy announcement itself was something that the RBI said about consumption, right? So they said that rural demand has been stable and urban demand has been improving. So urban has actually been a problem for a while now, where you're not seeing consumption happen the way that it used to, whereas the rural recovery happened earlier in this cycle. So I don't think this rate cut really boosts that. But I do think that in general, consumption has been improving. So if you look at GST collection, plus I think recently there's been an announcement also that they're trying to rationalize um, the slabs and move to remove the 12% slab and move either to 5% or 18%, right? So I think from that perspective, if you look at FASTag collection, these other proxies for consumption, you are seeing a fair amount of consumption. But if you look at things like, say, power consumption, I think this has been uh, a lot of places experienced unseasonal rainfall this summer. So power consumption actually did not go up. So then that automatically affects, say, like consumer durable in terms of how much you're adding there, right? And I think so there you need to be a lot more. Again, this whole thing tells you that when you have data points, uh, you actually need to go to the micro level and understand what's going on, because the broad-based approach, which worked very well over the last cycle, is not really working in this cycle anymore. Like you do need a bottom-up approach to making these decisions and choices. So I hope that helps or answers the question. All right. So next, assuming all other parameters remain the same, this repo rate decrease will benefit big banks, HDFC, SBI, small banks. Uh, I don't think so. Like I said, right? Like if you do a rate cut, it doesn't directly benefit the bank. It really depends on how things work out, because on one side your cost of funds comes down, but you may not be able to garner deposits because people would not want to invest or lock up their money for lower interest rates. You may take an impact on your net interest margin. So these are all like, it's not a one-to-one clear transmission. There are actually many moving parts. And uh, we need to also keep in mind that the rate cuts are happening because the economy is slowing down, which means overall, like the banking system, while they are being encouraged to lend more, there also has to be demand, right? So if there isn't demand, if you're not seeing investment happen, then you're actually going to have more of an issue. Does the ithought team also help with reviewing the overall personal assets and liability? Yes, of course. We can do a financial plan for you. This would cover almost every aspect of your personal finance, including, say, taxes, goal setting, insurance, uh, debt management. All of this would get covered within the financial plan. You can reach out to us. I think, let me just put the number in the chat. It's 9500027285. So if you just drop them a message and say that you're interested in financial planning, they'll get somebody to talk to you. All right. Okay, sorry, I should have mentioned OMO purchase is something known as open market operations. So the RBI is allowed, they're also the banker to the government, right? So they can buy and sell government bonds. And when you look at OMO, so that open market operations is abbreviated to OMO. And the idea is when the RBI buys bonds, they put cash into the system and they take out bonds from the system, right? So then liquidity increases. When they sell bonds, what happens is they offload bonds from their balance sheet and they take out cash from the system. So this transaction can either increase or decrease liquidity within the system depending on whether the RBI is buying or selling. Yeah, I don't think I have a clear answer to this question, which is why I gave you both sides of the equation, right? Like you need to, so at a micro level, you need to study that and come back and see which impact is greater, whether, your NIM compression is more or your credit to deposit ratio takes a bigger hit, or, if cost of borrowing allows you to be more aggressive in lending. there is no one right answer. You'll have to look at company to company and see how that's happening. And I think even when you do that, you need to keep in context that credit deposit ratios have been declining in the industry for a while, because there's been a lot of competition on the money market side from mutual funds. So there are other elements also which are sort of uh, disrupting the entire equation. Thank you, sir. I think if you've been in touch with Amit, he can definitely guide you on how to get your financial plan done. Uh, and no problem. I think I briefly shared my views on commodities. So we are positive on precious metals at this point in time. That is something that we feel is a defensive play, especially in a market where we want to be more cautious and more gradual with investments. Uh, this is something that we would be positive on. When was the last time the RBI cut rates and infused money in the economy? I think in 2018 they cut rates, if I'm not wrong. In 2017, 18, at that point, you had a slowdown, and then there was some rate cut that happened at that point because your inflation got very low. So I think right before COVID also you had some a rate cut even before, because 2019 there was a slowdown in the economy. So you had the entire auto industry, there was a problem there. You had the banking sector where they were cleaning up balance sheets. So you had the twin balance sheet issue. So I think at that point there was some sort of requirement to help uh, economic growth. But of course, COVID happened. So when you look at that period, it seems like it all happened together. But actually, that first rate cut was not because of COVID. That first rate cut was because the Indian economy was already slowing down. Do insurance companies have impact of the rate cut because they may have some investment in debt instruments? So a rate cut by and large is a positive thing in like for anybody. So insurance companies own long duration bonds because the idea is that, let's say you have to pay a pension to somebody who's going to retire in 10 years for the next 30 years, then you need to own a 40-year bond, right? So the duration risk that insurance companies have is higher, but usually, typically, this is also hedged in the sense they have some derivatives that help them manage that risk effectively. So I don't think, if you're looking at a well-managed insurance company, mostly this risk should be managed. And as long as the interest rates are coming down, there's no negative impact. It's only when the interest rates go up that you have a problem. So basic idea being that bond prices and uh, your interest rates move in opposite directions, right? So when your interest rates come down, your bond prices move up, which means you make a profit on any bond investments that you have. When your interest rates go up, your bond prices come down, so you could actually make a loss on any investments that you hold. Would the rupee lose its value when the interest rates go down? If yes, will it reflect in gold and silver? So I think in today's context, there is a lot more to rupee valuation. So if you're talking about rupee with respect to dollar is what I'm assuming you're asking about. And I think the dollar already has like several moving parts in terms of how that equation is. And you've actually seen the dollar depreciate this year. So you can track this index known as the dollar index or DXY, and you can see how that's been moving. I think gold and silver, if you look at how the price movement has been, there are many factors that influence this. So silver is an industrial metal. If there's industrial demand, then I think you could see prices move up. Uh, Gold, on the other hand, if you look at how central banks have been in terms of uh, sorry, gold, if you see how central banks have been prioritizing or uh, filling up their balance sheets, there has been a lot of interest in buying gold over dollars. And this has been something that has been happening since the last few years. It's not something that has started recently, right? The big trigger, of course, was the Russia-Ukraine war and the US freezing Russian assets. But definitely there is a continuity in terms of central banks looking at gold as an alternative. India and China in particular are quite fond of gold as an asset. You've also seen Russia shore up on that. So I think we need to, I mean, rupee may be one factor that's adding into it, but I don't think it's the key factor in terms of your gold and silver thesis. In the US, there's a debt problem and a problem in the bond markets. If will that reflect here also? Will the USA go into a recession? Uh, and when will that happen? Right. Okay. Lot of ifs in this question, so there's not much that I can really answer here. Yes, the US has a debt problem, but the US dollar is also considered to be the most stable currency in the world today. Will there be a recession? I don't know. You are seeing, so the commentary that's coming in from the US Fed and like Fed members is that the tariffs are creating a lot of uncertainty, and that is what is triggering a slowdown in growth because companies are unable to plan their investments, right? But if we look at the policy level changes at like a political level, what are the policies that they're trying to implement? They are inflationary in nature, but a lot of them are about supporting domestic growth. So will a recession occur? I think it's very, very hard to say, especially given that for the last few years you've had this. So previously there was always the fear that whenever your yield curve inverted in the US, there would be a recession that occurred in, say, the next few quarters. Now that has not really happened. The yield curve was inverted for quite some time. That time period at which the recession should have happened has not happened. You're also seeing a very robust job market in the US. And I think that is one of the things that has been keeping economic growth alive, even though you're at a higher interest rate, even though you're having another thing. I think the risk in the US markets is, of course, that asset prices have been elevated. So there could be a correction in asset prices. Whether that would trigger a recession or not is something the world has not even seen yet. So we'll have to wait and watch and see how that plays out. Okay, interesting question. So I think we have about 10 to 15 minutes left. And there are a couple of questions, but after that, I will sort of pause taking any new questions, right? So can you explain how rate cuts increase or affect currency? So there is something known as a carry trade, right? So when your rate is low, let's say today Indian interest rates are lower compared to like what is considered the historic average, then you can borrow at a cheaper rate in India. And let's say you have another country where interest rates are higher, and then you invest or you lend that money in that country, there's a difference that you make on this, right? So when you lower your interest rate, at some level, you're also devaluing the currency because money will flow out of that economy, and that can depreciate your currency. But it's never a one-to-one thing because currency may also strengthen. So let's say when the US cut rates, the dollar did not really depreciate primarily because it's considered to be the reserve currency. At the same time, we have cut rates, we have maintained rates, we've hiked them, we've cut them. We've had some level of stability. Even when we've increased rates, we've seen the currency depreciate, right? So it's not a one-to-one thing, but the basic idea is that you can do these things known as carry trades. And carry trades were in the news last year because you had the yen carry trade and Japan increased interest rates for the first time in almost 30 years. And that had a lot of this thing. So what we need to understand is currency plus leverage plus a few other factors is what is creating a lot of uh, changes, right? It's like, I mean, this is like a complex machine. So it's more of an engineering question. Like if you push something or if you pull something, it's not just that one thing that's going to move. There are other things that are connected to it, which are also going to get affected. Yeah, so I think this is a question on products. So Bandhan G-Sec bond value has come down in the last couple of days. Could we comment on that? So, like I said, usually when you have a big policy decision that comes in, there is a little bit of uncertainty as to how that will play out. So the initial market reaction to anything is a little bit overplayed, and you need to wait for the dust to settle on that before you take a call. But by and large, if you've already invested, you are going to look at, you're not at a bad place. You had a 1 day reaction in terms of how this duration call has played out. The basic idea is that you have to see transmission come in. And like I mentioned, if the RBI announces a rate cut, it doesn't have the transmission doesn't happen immediately, right? It takes time for that to play out. So you need to be a little patient with any duration product that you own, because there will be that up and down in that journey, and that's normal. And that's why entry level valuations matter a lot. Like we need to look at participating at the right time. Can we expect foreign companies get loans from Indian banks? In many countries, inflation is high. In India, it is the opposite, and the CRR cut, liquidity will go. Yeah, but then I think the reverse is also true, right? Like I think in terms of if you borrow from Indian banks and then you have to repay, or the currency depreciates, appreciates. So there are many variables in that equation. So I don't think I would look at this as a carry trade, because whenever you're looking at carry trades or like, leveraging in a different currency, there has to be some currency stability, which is not there in today's market, because otherwise you can't do that math, right? You could get hit either from the currency or from the interest rate or from something else. So there's too much risk in that trade today. Thank you. I think the questions were also equally good. Think we still have about 10 minutes, so if there are any more questions, I'm happy to take that. But in the meantime, I would like to thank everyone, because I think you've been there right from the start and it's been almost an hour and it is Saturday afternoon. So I hope everyone has a fun weekend ahead of them, and I'll still be here for another 10 minutes. You're most welcome. Have a nice weekend. I think dollar is a very tricky thing, and currency is one of the hardest things to predict. So I would not recommend anything. If there is a use um, in terms of dollar, so that's the thing, right? We're bearish on the dollar also. You don't know, because the dollar index has depreciated. You do have uncertainty in terms of fiscal as well as trade policy there. So and at the same time, if uh, the US wants to export more to the world and they want other countries to start purchasing US goods, they have to devalue the dollar. So there are so many moving parts, but you don't know how the net effect will play out. So the dollar could depreciate, the INR could depreciate, the INR may depreciate less than the dollar may appreciate, the INR may depreciate, so then you'd have that loss there. So it's really difficult to think about this. But let's say there is a reason for you to own dollars, in terms of, let's say you like to travel, or you have children who are abroad, or you want to send your children abroad to study, then it makes sense to hedge some of that risk by owning dollar denominated assets. If a bottom up approach is needed now, how does MF help in that? So I think this is where our expertise comes in, right? We do a lot of product research as well on the mutual fund side, so we know which funds follow what kind of philosophy, what the investment style is like, what the mandate is like, the thought process of the fund manager. So all of this is actually taken care of. Like that's where we are able to add value in product selection for an investor. And I think there are definitely mutual funds that are following this approach. It's not that it's not there at all. I wish I knew the answer to this. How long can we expect to go long in gold? I mean, if we look at past data, it's cyclical, right? And within, let's say, if you have a decade where gold performs, you also have in between periods where there are drawdowns, and those drawdowns can be anywhere between 5 to 25%. So I think what we need to expect is nothing is linear, meaning you can have a decade where gold goes up, but within that decade, you will have time frames in which it is volatile, and we need to be more dynamic in terms of that exposure to gold. How can one analyze debt mutual funds to invest? What are the key parameters to look at when analyzing a fund's portfolio? I would look at quality. I think that is the most important thing that I would study. What is the quality of the holdings? Um, and if once you know what the quality of the holdings are, then you can take a call in terms of understanding the structure, right? So SEBI has done a really nice thing in terms of categorizing debt funds in such a way that they're easy to compare based on the duration risk that they take. So if you're looking at different portfolios or different AMCs, then I think you can essentially go category by category and then you can look at that. Uh, I think you would also want to cyclically look at where the duration metric is. So at some points in the cycle, you will want to add duration. At some point on the cycle, you would not want to be exposed to that risk at all. So that's more of a cyclical call, and that's related to how the interest rate cycle is moving. But these are two things that I would definitely look at. And I think with that, you should have a reasonable grip on where to invest. Thank you, sir. That's very nice of you to say, and we will organize more sessions like this. If you have any other suggestions, please feel free to let us know, and we can obviously curate something that suits investors. For someone investing lump sum amounts in MF, how do I continue it now? So stagger, I mean, I think at one level, we take that layered approach, meaning any lump sum money that's coming in, that is anyway getting staggered through STPs. But let's say you know that this year you can invest so much money, then I would say that even what you're putting into the market, you try to stagger it over a period of time. Otherwise, you communicate with your relationship manager and you tell them that, okay, this is all I have saved for the year. If you guys want the money, then figure out how to do it because I won't be able to contribute again. Right? I think that's the way we need to approach it. You're most welcome, sir. It's a pleasure. I think so. One thing that we've done at ithought is to dedicate Saturdays to learning. So there will always be webinars that are happening on Saturday. And it's nice to see that so many of you still want to participate and spend some time learning something or asking questions and making an effort to move your portfolios in the right direction. Thank you. All right. So I don't see. Yeah, definitely. I think that would be lovely. I look forward to meeting you when you're in Chennai. So I don't see any new no autograph. Now I feel like you're just teasing. Uh, uh, yeah, I don't see any questions coming in, and we're almost at 5 o'clock. So have a great weekend, everyone, and hope to see you next month. Thank you for participating today.